This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
I want to move on to page 50. Urata Deauville, the goods, the 10,000 goods were going from Urata to Deauville. They cost Urata 10 and she sold them on at 10. This is not likely to happen in the exam. Mike buys goods for 10 and sends them to Vita, invoicing them at 12. Mike recognizes a profit of 2,000. So far as the group is concerned, that profit is not realized. How can I make a profit simply by taking a cup which cost me 1 cent and selling it to my subsidiary for 3 cents and then consolidate? That inventory in her records is overvalued so far as the group is concerned. I need to eliminate the unrealized profit. I have recognized it correctly. I have recognized the profit, but when it comes to consolidation, so far as the group is concerned, that's an unrealized profit. And we need to calculate what an pleasantly known, depending on your point of view, they're known as PUPs, which I'm given to understand has a meaning in certain overseas languages, particularly Romanian, where a PUP is a kiss. I have no idea what the word means in your language. It stands for provision for unrealized profit. Provision for unrealized profit. Didn't there used to be a nightclub here called Pups? Wasn't there a nightclub? Poo-poos? Pups? Pup-ups? No? A few years ago, you're too young to remember. I seem to remember when I first came out here, there was a nightclub called Pups. There is a difference between a markup, the expression markup, and the expression margin. It's a crucial difference. It's worth 2 marks. It will happen, probably, in the exam. The difference is the basis of the calculation of the profit. If goods are sold at a markup of 20%, that is quite dramatically different than goods being sold at a margin of 20%. And getting the wrong one is going to cost you 2 marks. Accept, will you, again, the fact of life that you need to be telling your own children that cost plus profit equals selling price. You can't argue that. I don't care where in the world you're from. This is a universal truth. Cost plus profit is selling price. The problem comes with this profit. This markup of 20%, markup is another word for profit. If I put 20 there, it's a markup. If it is a markup rather than a margin, if it's a markup, that 20% is a percentage based on cost. So every 120 selling price, transfer priced goods, every 120 in Vita's inventory of goods received from Mike, 20 of every 120 is Mike's unrealized profit. Mike sells goods at a markup of 20%. Vita buys these goods. Every 120 of those goods bought from me at a markup of 20%, 20 of that 120 is my profit. And it's still in her inventory. So far as the group is concerned, that profit is not realized. And I need to make a provision. The provision will reduce the value of the inventory, the group inventory. It's just going to take 20 out of every 120. It's going to take 20 out as unrealized profit. If I have an extract from the balance sheets, I've got inventory of 40,000 and 30,000. I've got retained earnings of 100,000 and 70,000. During December, I sold to Vita 30,000 goods, the selling price, at a markup of 25%. Vita has sold none of these goods. Something that I still do, and I have done for many years, is I write out this equation. Cost plus profit is selling price. I still do it. Every time I'm doing a consolidation question, I have to do it. It clarifies for me, but it also tells the marker what you're doing. The first thing to do is to put in the profit column 25. The next thing is to ask yourself, is this a markup or is it a margin? And it's a markup. And it's therefore 25% based on cost of 100%. That 100 has been marked up by 25% to give me a selling price of 125. So the profit element of these goods, the profit element for which I need a provision, is 25 over 125. Vita has inventory of 30,000. Don't care. What I want to know is how much of that 30,000 has been received from Mike at a markup of 25%. And the question tells us, during December I sold to Vita 30,000 goods at a markup of 25. Let me change the Vita inventory to 130. I've just changed the Vita inventory to 130. Only half of you have made that adjustment. I've just changed the Vita inventory to 130. It was 30. I've moved it to 130. Okay. The profit element is 25 over 125. Of Vita's closing inventory of goods bought from Mike. Vita's closing inventory of goods bought from Mike is 30,000. Included within this 30,000 is Mike's profit, which so far as the group is concerned is not a realized profit. So we have to have a PUP calculation. And the PUP calculation says every 125 that Vita has in inventory from Mike, 25 of it is profit. So 1/5 of 30,000 is 6,000, and that's the PUP. $6,000 PUP. It's an unrealized profit. It's an overvaluation of inventory. Vita's inventory, 130,000, is overvalued by 6. My profit of 100,000 is overvalued by 6. Does it make any difference to you when I cross out this inventory and I get to 170 minus 6 is 164? Does it matter to you if I've taken the 6,000 off there or off there? It's still going to be 170 minus 6. Doesn't matter where I take the 6 off in the inventory line, whether I take it off Mike or take it off Vita, doesn't matter. But what is important is that I adjust the profit, I adjust the retained earnings in the records of the company which has recognized this profit. It's Mike's profit which is overstated. The 6,000 has to come off Mike. If it had been Vita selling, then the adjustment will be against the 70,000 Vita retained earnings. So the adjustment, once you've calculated the PUP, the adjustment is reduce total inventory, but crucially, it's debit the retained earnings of the company which has recognized the profit. In this situation, Mike was selling to Vita. In an equal situation, Vita could be selling to Mike. In that latter situation, the adjustment would be made against the Vita retained earnings. But this adjustment is only necessary on the closing inventory of the intragroup traded goods. I said up here, I said Vita has sold none of these goods. What if Vita sold 2/3 of these goods? What's the adjustment then? Say again, Svetlana. We need a PUP of 1/3. Yeah, because she sold 2/3. We only need the PUP on what she's got left. We only need the PUP on her inventory. And if she's sold 2/3, then she's only got 1/3 of them left. So this PUP of 6,000 would need further multiplication times 1/3, a PUP then of 2,000. Is this clear? I'm very clear in my, I know what I'm doing. Do you know what I'm doing? Okay. So in that situation, if Vita has sold 2/3 of the goods, then we need a PUP on the remaining 1/3. Vita sells 20,000 goods to Mike, recognizing a gross margin of 15%. I'll keep it easy. Mike has sold none of these goods. As at the year end. What's the PUP? What's the adjustment? I did say early on, about a quarter of an hour ago, I did say early on there's a huge difference between markup and margin. There is a big, big, big difference between something which is expressed as a markup and something which is expressed as a margin. Here, the markup, the 20%, was based as a percentage of cost. With margin, cost plus profit is selling price. It's 15%, but this time it's a margin. It's 15% of selling price. It's not 15% of cost, that will be markup. It's 15% of selling price. If profit is 15 and selling price is 100, then cost must be 85. But you know, only very, very rarely do we need that information. We don't need to know it's 85. All we're trying to do here is work out what is the unrealized profit element. That's what we're doing, is we're calculating the unrealized profit. And in this situation, Vita sells to Mike. What's the unrealized profit? $3,000. Yeah, $3,000. It's 15% of the transfer value. It's 15 over 100 times 20,000. That's the figure for the PUP. Where's the adjustment? The adjustment is because inventory, my inventory is overvalued by 3,000. My inventory is overvalued by 3,000. But it doesn't matter if it's my inventory or Vita's inventory, because all we're going to do with inventory is add it across, adjusted for the 3,000. So it doesn't matter if you put -3 against me or -3 against her inventory. It doesn't matter. What is important is that we adjust the right retained earnings. Which company has recognized this 3,000, which, so far as the group is concerned, is not realized? Is it Vita that's recognized the 3,000? Or is it me? Ginter front. It's Vita. So this 3,000 is an adjustment against Vita's profits. I did have some say profits appear, didn't I? It's there. It's going to come off. 3,000 off there. And just for the sake of keeping it in the same records, I'm going to take 3,000 off Vita's inventory. But it doesn't really matter where I put the 3,000 inventory adjustment. What is important is the 3,000 comes off the Vita retained earnings. In your answer in an exam, you'll write PUP calculation, cost plus profit equals selling price, 15% margin. 15 over 100 times 20,000 equals 3,000. This is what you should be writing in the exam. In V, reduce inventory reduce retained earnings. That's what I would write in an exam. That's what would appear on my answer book. For the first one, which was what? A 25% markup. Cost plus profit is selling price. 25 markup equals 125 markup. Show the marker, you know what you're doing. Profit element is 25 over 125 times 30,000 equals 6,000 PUP. In Mike, reduce inventory, 6,000. Reduce retained earnings, 6,000. That scores 2 marks. You'll need 48 more. And it's done in no time. It's quick and straightforward and easy, so long as you're confident about what you're doing. And that means practice. Unfortunately for you, and fortunately for you, if you look on page 194, you'll see 10 questions involving PUPs. Question 3, 4, 5, 6, 8 and 10 all involve an associate company. So I don't want you to do those. But you could sensibly do question 1, 2, 7 and 9. This evening. I've said everything I want to say on page 50, except that you should make the adjustment on the face of your question paper. And that takes me on to Petrus. Question on page 51, Petrus and Signa. Just concentrate for another 15 or so minutes. Just a big effort now, a big push to the finish line. Got the introduction at the start of example 2. We've got the notes at the end of the question. There were no inter-entity balances, so there's no cancellation of debits and credits, no cancellation of receivables against payables. But during December, Signa sold goods to Petrus for 60,000. Signa sells goods at a markup of 25. Petrus hasn't sold any of them. And the directors of Petrus value NCI on a proportional basis. Well done, those of you that saw retained earnings in this goodwill calculation. Retained earnings are 0 because we bought the shares on the date of incorporation. The birthday of the subsidiary. It's not had time to make any profits. So the net assets fair value at date of acquisition is 200. We're going to value the NCI on the basis of the proportional share 25% of 200 is 50. We're therefore comparing 200 with 200. There's no goodwill. What comes after working 2? Ginter. What comes after working 2? This is not rocket science. What comes after working 2, Lena? Working 3 is a good answer, but it's not right. It's not right. We can't do working 3 until we've done the PUP, because the PUP is going to affect working 3. So PUP calculation is next. It doesn't have a number. PUP calculation. Cost plus profit is selling price. Some of you have started with this. What I saw, those of your answers that I saw were all right. This is a markup of 25%. There's your 25. It's a markup, therefore it's based on cost. Selling price is therefore 125. The profit element included in the selling price is 25/125. PUP is therefore 25/125 multiplied by the closing inventory of these intra-group traded goods. The closing inventory, well, the 60,000 was sold. Now, how many of that 60,000 have subsequently been sold on to the outside world? None of them. Petrus has not managed to sell any of these goods, so the PUP is therefore 12,000. One of you's got 15,000, as I remember. One of you said it was a 25% gross profit. It's not 15, the PUP is 12,000, not 15. That's the PUP. The adjustment is in Signa. We're going to reduce inventory by 12. We're going to reduce Signa's retained earnings by 12. As at today's date, not at date of acquisition. This is as at today's date. This affects working 3. It does not affect working 2. Working 2 was 14 years ago. This is now. This is a working today as at the year end. Now we can do working 3, Petrus and Signa, per the question, 300 and 150. Take away the PUP. It's included in that 150. The PUP, the unrealized profit, is included in that 150. I need to deduct 12 from Signa's profits. It could have been that I was deducting 12 from Petrus. I'm not in this example. Petrus is not the one who's recognized the profit, it's Signa. But it could be the parent selling to the subsidiary. It isn't in this example. But you have to be very careful which column you put that adjustment in. So now I'm looking at the adjusted Signa profits of 138. And that's at today's date. I need to take off the pre-acquisition. The pre-acquisition Signa profits, 0. In this example. Therefore, post-ac is 138, and our share is 75%. 103.5. H is M plus H's share of S post-ACCA retained, 403.5. Less goodwill impaired since acquisition, but there is none. So consolidated retained earnings, 403.5. Working for the NCI is 25%. They want their value at date of acquisition, which was 50,000, wasn't it? And they want their share of post-ACCA retained. But we can get that from here, 138 is the post-ACCA retained. So they want their share of 138. 25% of 138, 34.5. Less their share of goodwill impaired since acquisition, but there is none. That's the NCI. Inca. Irina? How much? 0. TNCA, 500 and 250. Inventory, 130 plus 70. Minus 12. Others, 160. $10.98. Shares. What are the next 3 words? Say it, Vita. 450. What? 450. 4 times ago? $450. Retained earnings is in working 3, and that was 403.5. NCI is working 4, and that was 84,005. Liabilities, 130 and 30.